Picture this. A company posts literally the best quarter in its entire corporate history, and its reward is watching its stock slide straight down to yearly lows. Make it make sense, right? Well, it's June 25th, 2026, and Nvidia just delivered a jaw-dropping earnings report, yet the stock is hovering down in the $194 range. We are going to dissect what might be the ultimate market anomaly.
Okay, let's just get right into our investigation. We're going to unpack the hard facts, the interpretations, and the future scenarios, and we're doing it with zero hype. We'll look at the current repricing paradox, Nvidia's massive hardware moat, the escalating three-front war they're fighting, shifting valuations, upcoming catalysts, and finally, we'll give you a concrete investor verdict. So let's kick things off with what we are calling the repricing paradox. Here is the massive mystery we're dealing with today. Q1 of fiscal 2027 was, by all accounts, a quarter of absolutely flawless execution for Nvidia. Yet, it clashed violently with a brutal AI sector sell-off that pushed the stock down to roughly $194. The company is doing literally everything right, but the price action is aggressively negative. So what is actually going on? Let's ground ourselves in the verified facts first. Nvidia posted a record $81.6 billion in Q1 revenue. Let that sink in for a second. That represents an 85% year-over-year acceleration. To put that into perspective, they're pulling in more revenue in a single 3-month quarter than most major legacy corporations make in an entire decade. And this right here perfectly illustrates the disconnect we're seeing. On one side, you have fundamental reality, $75.2 billion in data center revenue alone, plus a massive $80 billion stock buyback authorization from the board. On the other side, the market reaction, shares just keep sliding. The crucial takeaway here is that the market isn't doubting Nvidia's underlying business. Actually, scratch that. It's more like the market is actively compressing the valuation multiple because of broader macroeconomic fears and concerns that we might be hitting a peak in capital expenditures. The business itself is incredibly healthy. The price tag is just being aggressively renegotiated by Wall Street.
Now, if the business is completely fine, we really need to look at what's actually driving it. And that brings us to their physical architecture.
Just look at the sheer velocity of innovation on this hardware roadmap. We transition from Hopper over to Blackwell, which introduced native FP4 compute at 9 petaflops for some truly massive efficiency gains. But then comes Rubin in late 2026, leaping all the way to 50 petaflops with 22 terabytes per second of bandwidth. It's wild. This aggressive annual cadence essentially forces hyperscalers into a continuous, never-ending upgrade cycle. You simply cannot afford to run last year's chips when your biggest competitor is already spinning up Rubin. But hardware specs don't tell the whole story. The real mode protecting Nvidia's astronomical 75% gross margin is actually their software. With over 4 million developers locked into their proprietary CUDA ecosystem, competitors can't just build a faster chip and call it a day. They literally have to convince an entire global industry to completely rewrite their code from scratch. That deep structural customer lock-in is, without a doubt, Nvidia's most durable advantage.
Of course, an advantage like that attracts a whole lot of competition. Let's look at the current market share battles. Here are the competitive facts on the ground right now. Nvidia clearly retains a massive lead at an estimated 75%. AMD is definitely carving out a credible 10% for itself. But it's this gray area, custom ASICs at 15%, that's quietly becoming the biggest structural threat in the room. Hyperscalers like Broadcom and Google are designing their own highly specialized silicon, and that custom market is growing incredibly fast. And the last 30 days haven't exactly been smooth sailing either. We've seen some significant bearish developments. SK Hynix just announced a slowdown in their high-bandwidth memory expansion, which is a critical component in AI GPUs. That signals softer downstream demand. On top of that, Amazon is stepping into the external AI chip market. Plus, U.S. export controls have effectively zeroed out Nvidia's $15 billion China data center market. These are very real regulatory and competitive risks dragging down sentiment right now. If you want bull versus bear stock analysis without hype, subscribe to Future Ready channel. So, how are the big institutional players reacting to all this noise? Let's check the sentiment. Well, on the incredibly bullish side, Software Equity Research just came out with an outperform rating and a very aggressive $300 price target. They're arguing that the rise of agentic AI, where AI can autonomously chain multiple complex reasoning tasks together, is a massive, completely new growth vector. They believe Nvidia is shifting from a highly cyclical hardware business into a recurring revenue platform, and in their eyes, that justifies a much higher premium. And if you read between the lines of recent Wall Street transcripts, institutional buyers are totally obsessing over one specific metric: the lifetime cost of an AI factory. They care deeply about token per watt efficiency. Because NVIDIA's chips, especially the new Blackwell and Rubin architectures, drastically lower the energy and capital costs required to generate a single AI token, they maintain an absolute, unmatched, total cost of ownership advantage over everyone else.
But sentiment remains incredibly mixed, even inside the company itself. Look at this. On one hand, we have the ultimate vote of corporate confidence, the board authorizing a staggering $80 billion share repurchase program. But on the other hand, we're seeing multi-million-dollar insider sales, including director Mark Stevens recently unloading $186 million worth of stock. It's a classic real-time battle of conflicting signals, and it's exactly what keeps the volatility so high right now.
All right, let's look ahead. What are the major catalysts that you should be watching next?
This timeline lays out NVIDIA's relentless release cadence. We have the Rubin platform launching right now in the second half of 2026, followed really closely by Blackwell Ultra. Then we get Rubin Ultra in 2027 and the Feynman architecture in 2028. You guys, this isn't just a product roadmap. This is literally the industrialization of the AI token economy. By guaranteeing these massive performance leaps every single year, NVIDIA's effectively securing those future hyperscaler revenue pipelines. But there is a major unmodeled future scenario sitting out there that almost no one has in their spreadsheets: the China re-entry wildcard. Now, we strictly report the facts here without taking any geopolitical sides, and the fact is, current consensus models assume absolutely zero revenue from China. Zero. If global tensions were to thaw and export restrictions eased even slightly, it would introduce an immediate $10 to $15 billion revenue upside that the bears simply cannot model for right now. If you want bull versus bear stock analysis without hype, subscribe to Future Ready channel. Okay, we've covered a lot of ground. Let's bring all this evidence together into a clear decision framework. We've got to weigh the strongest arguments from both sides entirely impartially. On the bull side, Blackwell GPUs are completely sold out, and analysts project AI capital expenditures to expand by an incredible 36% annually through the end of the decade. On the bear side, we are actively watching severe valuation multiple compression, driven entirely by fears that we're repeating the telecom infrastructure bubble of the late 90s, where massive, rapid buildouts led to years of painful digestion.
So how do you actually play this? Well, for swing traders, the evidence right now absolutely dictates a cautious stance. Near-term momentum is undeniably negative. The stock is testing key support levels right around $194. Plus, news like the SK Hynix slowdown is acting like gravity on the entire semiconductor sector. If you're a short-term trader, the rational move here is to sit on your hands and await clear technical confirmation before stepping in front of this intense volatility.
However, if you are a long-term investor, the framework points firmly to accumulate. Why? Because the underlying business is literally stronger than ever. The CUDA software moat is compounding daily. Their token per watt unit economics remain totally unmatched by rivals. And frankly, a forward price-to-earnings ratio of 30 is historically cheap for a company growing top-line revenue at 85%. Furthermore, the shift to agentic AI ensures demand durability well beyond this initial training phase. If you want bull versus bear stock analysis without hype, subscribe to Future Ready channel.
Therefore, when we draw upon the verified fundamentals, the pristine financial health, and that undeniable structural moat, our final evidence-based verdicts for long-term horizons is to accumulate. The market is currently giving investors a rare opportunity to buy the dominant infrastructure provider of the entire AI era during a very specific, sentiment-driven phase of multiple compression. Before we wrap up, I want to leave you with one final question to ponder. As NVIDIA continues to post record after record, we have to ask ourselves, are we currently witnessing the construction of the largest, most profitable infrastructure expansion in human history? Or are we just front-loading a massive telecom-style bubble that's going to burst? The answer to that question is going to define the next decade of wealth creation.